it came through a contrarian view. So I started to describe to portfolio companies that I wanted to help them more than what my job description basically covered. And everybody was like, that's useful, but there's a stigma to that in the ecosystem. Like, I don't need a broker. I don't want a broker. I don't want to get a message from a broker when I'm raising capital, me as a VC. But I thought there has to be a better way.
Hi, everyone, and welcome to La Frontera, a podcast dedicated to exploring the dynamic startup and venture capital ecosystem in Latin America and the innovators behind it all. We're your hosts, Cyrus and Tom. If you enjoy this conversation, we invite you to subscribe to our newsletter where we announce new episodes and share additional insights and resources for founders and investors alike. We'd also like to invite you to share this podcast with your friends and to leave a review on Spotify, Apple, or YouTube to help more people discover the show. We love hearing from our audience. You can connect with us on LinkedIn and Twitter by searching for La Frontera Podcast. Hey folks, welcome to another episode of La Frontera. We're your hosts, Cyrus
and Tom.
Today we're here with Marcial Fraga, founder and CEO of OS, a fundraising advisory firm that works with Latin America's top founders to help them craft their narrative, prepare their process, and execute their raises with strategy and discipline. Marcial, welcome to the podcast, and thank you so much for being here.
Thank you for having me, guys. I'm so excited to be here with you. Cyrus, Tom, thank you so much.
Amazing. Well, I'd love to start with providing our listeners with some background, like in like what you've done before OS. So would you mind just like walking through previous jobs, background?
Absolutely. Like one of those, I think the quote of Steve Jobs that looking back, everything makes sense. But I'm going to go roughly in chronological order. I think a good starting point is finishing school, like university, and thinking I need to be working at a big city consulting firm and just go telling these industry experts about my ideas as a 22-year-old. I did an internship and quickly realized I was not put on this earth to do that. And I was extremely lucky to land a job at Mercado Libre, which is the Amazon of Latin America, basically, doing kind of like strategy for their customer support team. And we were working the same hours as big city consulting firms. But that was so exciting, basically, just learning how to work, which is something that rarely gets talked about. In your first job, you're going to learn how to work. And I had another strike of luck, basically, that everybody from my team quit. And they told me, Marcial, you need to find another job within the company if you want. And I saw this team with 3 people that their mission or their hypothesis was that we could create a lending business unit within Mercado Libre. And I thought this is so exciting, especially in Latin America where access to loans is not very straightforward. So I joined that team. And that team became a business unit in and of itself. And I learned recently that it's currently bringing 25% of the revenue and 40% of the EBITDA for Mercado Libre. Wow. Yeah, incredible.
That's incredible.
And yeah, I was 22, 23, 24 years old at the time. And I decided to try my luck as an entrepreneur, as a 24-year-old. And the main reason why I decided to make that leap was because I needed to add more risk to my life. I was being too risk averse as a 24-year-old with basically everything handed to me in a silver platter. So I jumped ship and I had 2 missions. 1, build a company, and 2, speak with people that know how to build a company. So at the same time, I was trying to figure out a thesis whilst interviewing founders. And if the conversations were going somewhat decently, I would ask them at the end, like, hey, if I offer you 20 hours of my time next week, what can I help you with? And so over the course of the next 4-6 months, I ended up collaborating with 10 different startups, helping them assemble a pitch deck, hiring a head of product, or thinking about their product roadmap, or whatever came up. And after those 6 months, I figured out, hey, I really, really like spending time with founders. And I kind of dig this vibe of entrepreneurship. So at that same time, I started building my online presence on LinkedIn, which was a great decision back in the day, although I post often. And every time I'm about to post, I get a little bit of imposter syndrome, but I do it anyway. Long story short, I decided to take 2 jobs. The first job from 6 a.m. to 2 p.m. was collaborating with a LinkedIn influencer called Marcel van Oost, who's a guy from the Netherlands. He posts every day about fintech. And I told him, I want to grab your audience and I'm going to build businesses underneath it. So we build an angel syndicate. We build a consulting firm to help banks, and we were building the media company. And from 2 p.m. roughly to 10 p.m. in the evening, I was the co-founder, COO of a Toast for Latam play in 2019, 2020, where the idea was, let's replicate what these guys are doing in the US. They're growing like crazy. What can we do here in Latin America? Hopefully Rappi is going to buy us out, or somebody's going to buy us out pretty quickly. We're going to become millionaires, financial independence, retire early. And you can already see why that story has not happened. A year later, many mistakes in fundraising, many mistakes in operations. That was on me. Many mistakes on product. We decided to close the business down, and I did not want to collaborate with global fintechs anymore at that time. So I decided to join very early the Latitude team, and I spent 3 years alongside them. I told them from day one, I do not know how to invest in startups. They told me, we trust you. And they allowed me to do, 50, 60 investments over the course of 3 years, taking big risks, making a lot of mistakes. And that was my MBA, because that's the point in time where I learned about business models, where I learned about founder mentality and co-founder agreements and how businesses scale and the mistakes that you can make in the first minute, in the second minute, or 30 minutes down the line. And after 3 years of doing that, I realized my passion, like I couldn't escape my passion, which was and is and will be probably helping founders. And the areas where I can help founders the most is because I have such a strong understanding of what goes on in the kitchen when a VC is analyzing a deal. I can put that in the hands, if I can knowledge transfer that and put it in the hands of founders, then I'm going to create leverage for them. And in this dance, this fundraising dance, the leverage is usually tilted towards the VCs. But if I can turn that in favor of founders, then I'm going to be supporting what I consider to be category defining startups and give them a fair chance to fight and get through those fundraising moments, in particular in the Series A, where take the founder that's raising a Series A. It's probably she or him has probably been operating for 3-4 years now, has 40 people on their team. They've raised capital before. They've just found some sort of product market fit, but they still have 6 months of runway left. Right? And you face this point in time where you're going to be tested by 30 or 40 investors who are going to make up their decision within 10 minutes of meeting.
Yeah, no, that's so important. And it seems like your background of being a founder and, obviously having challenges with the fundraising as a founder, investing and getting to work with these various founders and seeing how they pitch you as you were an investor, kind of really led to kind of where you are right now, which is the founder of OS. Can you describe a little bit more about what you do at OS and what was the aha moment that really just made that clicked for you, that you were like, okay, like OS is what I want to do? Because I think there's a little bit more of a meaning behind the name of OS as well, right?
Absolutely. There are many aha moments. From an emotional perspective, I have to mention the first one. I was 3 years old. I was not being able to settle down in kindergarten, and my dad was able to stand by my side, sitting in the kindergarten class for weeks. And the reason why he was able to do that was because he was an entrepreneur himself. And that meant that, for better or worse, he controlled his time. And it wasn't without any backlash, but he was able to stand by my side at that time. So that really inspired me to want to give back that to other entrepreneurs. But then, Cyrus, it came through a contrarian view. So I started to describe to portfolio companies that I wanted to help them more than what my job description basically covered. And everybody was like, that's useful, but there's a stigma to that in the ecosystem. Like, I don't need a broker. I don't want a broker. I don't want to get a message from a broker when I'm raising capital, me as a VC. But I thought there has to be a better way. Like, why can't I try to rewrite some of these rules and how this helping founders approach happens? And the aha moment was when I was at Latitude. Pomelo was raising a Series B at that time. And internally, because we had invested in the pre-seed round, we were, of course, incentivized by them raising a Series B. And I remember talking to my partner saying, hey, maybe we should drop everything else that we're doing and just concentrate ridiculous amounts of efforts to help this company raise. And they were like, yes, Marcial, we can do maybe a call here and there, but they don't need help. They are Pomelo. And I was like, but if you understand the power law, it is highly likely that our returns are going to come from one or two winners. And Pomelo is very likely looking like one of those one or two winners. So we should drop everything, go on the road with them, tattoo our foreheads with the word Pomelo, wear their hats on every single call. We need to do everything in our power to try to help them unlock that excellence. And again, the answer was, Marcial, the best ones don't need help. And I wholeheartedly disagree. Cyrus, behind you have many sports gear. Tennis players, even the best ones, they have coaches. Skiers, they have coaches. Michael Phelps had a coach. You're not teaching that guy how to swim. You're making sure everything that he cannot control is working in his favor so that he can maybe shave a decimal, like 0.1 seconds, 0.2 seconds in a race. And that might be the difference between gold and not placing in the podium. So I'm here to work with founders that are Olympic athletes to try to get them from third place, fourth place to gold medal. Tennis players, even the best ones, they have coaches. Skiers, they have coaches. Michael Phelps had a coach. You're not teaching that guy how to swim. You're making sure everything that he cannot control is working in his favor so that he can maybe shave a decimal, like 0.1 seconds, 0.2 seconds in a race. And that might be the difference between gold and not placing in the podium. So I'm here to work with founders that are Olympic athletes to try to get them from third place, fourth place to gold medal.
So then I guess thinking back to your time at Mercado Libre, Latitude, etc., what are some of the lessons you learned there and some of the environments that you worked in that kind of shaped how you work today, how you operate, how you treat founders?
It would definitely have to do with the perception of making mistakes. In Latin America, making mistakes is seen as something with an extreme negative connotation. And the more I started to collaborate or get osmosis basically with the US ecosystem, where making mistakes is the part of the progress of getting to the right answer, that drastically changed my risk aversion. And you look at it from afar, or at least in my position as a venture capitalist, you see all these founders coming and going, and everybody is risking everything to try to get up and running. And I would even always, one of my pet peeves as a VC was that in the first meeting, I would barely ask you about your company. And I would only ask about your upbringing, your personality, your traits. And I would get obsessed about the appetite for risk taking, because I wholeheartedly believe that as human beings, we're biased to not take enough risk. If we actually map and see what those risks could actually evolve into. So I learned that at Mercado Libre. The founders of Mercado Libre, they just they see a risk or they get scared, and it immediately triggers in them the reaction of going straight towards that. It's like a magnet. When they are scared, they go straight towards that. And I try to implement that in my life. And it was scary to decide, hey, I'm a principal at a fund that has huge connections and great reputation, and I can just surf this way. But it wasn't satisfying the risk appetite that I had for my life. So I sat down with my wife and I told her, please walk alongside me, bear with me. Let's give it 2 years to see whether or not this makes sense. And it'll be 2 years now in roughly 3 to 4 months. And we're both very happy that I took this jump.
I love that. So I want to pivot and learn a little bit more about the work that you do at OS, because I think when we first met, I think it was probably like a year ago at this point, or maybe I think it was probably about a year ago at this point. I remember talking to you and just thinking, I was like, wow, we're so incredibly aligned in terms of how we approach this. And I think what was really incredible was just like the way you approach the building OS. Like you work on like a referral basis. You're pretty selective with the founders that you work with. And then on top of that, you do have like this sherpa mindset, right? Like you're guiding them along the way. You're not doing the work for them, but you're setting them up for success. And part of that is like coaching them with like the storytelling and how to pitch their sharps and things like that. So, VC selection, et cetera. Can you dive a little bit more into number one, like how you select the founders that you work with? And then I'd love to dive into more of like the day-to-day kind of work you do with them afterwards.
Do you mind if I start with a quick story on why it's called OS?
Let's do it.
One of the entrepreneurs that I most admire is my father-in-law. He was born in Japan right after the Second World War. And when he was 22 years old, his karate sensei told him or invited him to jump on a boat, sail for 60 days in Argentina, and spread karate through all of Latin America. With no hesitation, he jumped on that boat, he came here, and he is basically the most important karate practitioner outside of Japan right now. Second after him is my mother-in-law. And there's a word that they say 100 or 200 times a day. They finish every sentence with this word, which is os. And I had to ask, what does os mean? And they told me it means to endure under pressure. And what you're telling the other person when you're telling them os is that they can count on you, that you will endure with them under pressure. And that is a very strong message that I want to share with the founders that I work with. So this is not a scalable business. I'm not building os to try to maximize the number of startups that I work with and try to make very efficient use of my time to add value to them. os is meant to, I believe, or actually empirically, I'm convinced that a handful of startups are going to change the landscape of Latin America. It's not going to be 100, not even dozens. And these companies that are striving for greatness, that are rewriting the rules of how we operate, they deserve as much leverage as possible. And if they are spending time at midnight writing an investor update because the quarter finished, I don't like that. They should be talking to customers. They should be building the product. They should be recruiting the most amazing talent there is. So if I can help them by providing them leverage with these types of efforts, then this is kind of like my job. When I started off, my hypothesis was mostly around the Series A benchmark. And it was also the founders that are maybe amazing operators, but maybe not amazing fundraisers. So I worked, for instance, with a founder. He's the son of Bolivian immigrants, born and raised in the Patagonia, only one of 4 siblings to graduate high school, went to university, started working at Western Union. After 12 years in Western Union, this guy decides to build a new infrastructure for remittances in Latin America. The operations that the company's going up and to the right in every single metric that you can track. And when he goes out to raise capital, he's going into meetings with investors with somewhat of a sloppy English, saying, thank you for the meeting, thank you for your time, basically giving out all the leverage in those conversations. This, I have no doubt in my mind that he's going to win. No doubt at all, because if for some reason a meteorite hits the earth and shuts down his company, the next day he's starting the company again. And there are a few founders like this with this founder market fit that I just want to help with whatever I can. And if I have to narrow it down to a very succinct and clear value proposition, I will embed myself into your company as some sort of a head of fundraising with my team. We're going to go into every single team, product operations, business, finance, marketing. We're going to understand the business inside and out. We're going to spend ridiculous amounts of time doing that. We're going to help you understand whether or not you have to raise. If you do, we're going to prepare alongside you. We're not a third party that you outsource and comes back with a nice looking financial model. We're going to help your financial team build a world-class data room. And the product team that's probably never seen a data room, we're going to show them how the best in class do it. Then we're going to work with the founder and the existing investors so that we assemble a team around the raise. It's critical that your existing investors are very bullish on your opportunity before you go out to raise. And founders underestimate this. They believe that because an investor invested maybe 18, 20 months ago, that they'll always be by your side ready to fight alongside you. But you have to convince them. You have to continuously put in the work so that they are fully aligned in the risks that you're taking, in the size of your opportunity. So we're going to start with that. After we do that, after we're ready and we've identified who we're going to pitch, we assemble a strategy with a go-to-market strategy, like any enterprise B2B would approach it, and we run the process. Now, I was being interviewed alongside another founder, and they were asking him about the keys to a successful fundraise because he had been successful. And I interrupted the question and I asked the founder, in your last round, what was your conversion rate? And he said, I pitched 80 funds and 2 invested. Okay, so you got a 96, 97% rejection rate. Yeah, and you're giving like best practices because this game is so skewed towards failure that one of the most important things that a founder needs to do during the process is to not get contaminated by the no's and to not change the story. Because if you start to iterate your story based on the rejections, you're going to build a Frankenstein, and that Frankenstein is not what you were set out to build, and it's not your pitch. And if you change that pitch because of the naysayers, then when you finally come and you're speaking with a fund that is a perfect fit, you're going to pitch something that is not appealing to them. So that's another part of walking alongside a founder and helping them through the process of raising capital. Then, of course, helping them not make mistakes. I start by interviewing them, and I record one of their meetings with VCs. And the two things that I'm looking for are, number one, what percentage of the time were you speaking versus them? In my perspective, founders should not speak more than 50% of the time. And number two, when you are speaking, what percentage of the time are you talking about the past, the present, or the future? Because many founders, they want an A+ in their report card. But VCs, what you're asking them is pay a ridiculously big price for jumping on this road now because of the benefits that are coming in the future. And that framing is a much stronger framing than we did great in getting up to here. Invest, pay a ridiculously big price in the hopes that we have a strategy to carry on.
So how do founders get their story right from the beginning? I know you talk a lot about preparing thoroughly, the positioning their story right, and then just executing throughout the fundraising rounds. But like, how do founders do that? Because I do know a couple of founders right now that have been going through various, accelerators, or they're gearing up to fundraise right now. And I think the biggest things that founders trip up over is going to be around how to tell the right story about what's their secret sauce, what makes them special, and why they should progress through the investment conversation. So how do founders do that right from the beginning?
How much time do you have, Cyrus?
We've got almost all day, right? What's the SparkNotes version, I guess?
Let's break it down. But where I add the most value to a founder is I'm not going to know more about your story than you, but I know more about what's going on the other side. And it's not about necessarily your story. Like the VCs, they are capital allocators. They have a single goal of multiplying and returning money to their limited partners. They will invest in you as long as you match their investment thesis. So you talk about the secret sauce, you talk about, or founders want to talk about their product roadmap, and they want to talk about the KPI that finally broke even or something like that. But if you zoom out a little bit, that's only relevant if a certain things have already been proven true. One of those things is this market big enough to build a company the size that a VC needs for their exit? Is this fund investment, are they investing at this time, at this stage of your startup, or maybe you're too soon or you're too late? So you're playing the other person at the other end. If I'm pitching an analyst, I'm not pitching the same way that if I'm pitching an associate or a principal or somebody that's further ahead. I was talking with a founder and I was telling them, if you're pitching an analyst, your job is to not give them an excuse to say no. And one of the easiest ways to do that is by letting them know, hey, if you say no, you're never seeing this company again, because the next time I fundraise, I'm going to be, open brackets, outside of your investment thesis. And just by nailing this or a few other traits, you're already understanding how the internal process works at the VC side of the equation, and the analyst is handing the deal over to the principal. Hey, maybe you should take a look at this because it has some merits and I'm not sure yet whether we can say no. Then you play the game and understand how to beat the principal, like a video game that you have any tricks to go through the levels. And then you get to the partners, and then who knows if they're having a good day or not. But I mean, founders tend to overemphasize the intricacies of their startup. And in my experience, it has much more to do with the narrative arc of this is a problem worth solving. Solving this problem is going to yield a VC backable startup in the space. This is our claim to why we can be that startup. But it makes no sense to say we are an amazing startup. Let me then pitch you the market and these other things, because of how our minds make up decisions.
Can you define for us VC backable?
Sure.
Maybe do some math. You have a whiteboard back there? I don't see one. But
I don't, but we're going to make it as easy to follow as possible. This is one of the things that I love to do with founders the most, because you need to understand what you're pitching. Let's all close our eyes and imagine we are a B2B fintech about to raise a Series A. you got your metrics, you're at 3 million ARR, cohorts are doing great, your team is assembled, you just found a CPO who was a head of product at a firm or whatever. And now you're pitching a fund. And let's think through the math of how a fund is making decisions. This fund, let's say, is a $300 million fund, and they are expecting from that allocation to venture capital at least a 4x. They're not interested in matching the S&P. So a 4x would be transforming 300 million to 1.2 billion. Now into the fund. From those $300 million, 60 are going to get separated into management fees. They charge 2% per year for 10 years. That's $60 million. And the 240 remaining, they're going to invest it into startups. For the sake of it, let's say there's no capital for follow-on. They're going to do 24 checks at $10 million a pop. And all of the investments are going to be $10 million at a $50 million valuation. Now, there are two things that VCs know. Thing number one, almost all startups die. That's empirical, barely 1% survives. And the other thing that they know is that the winners win very, very big. If you look at the data, I think it's 0.3% of startups that represent 97% of the profits ever generated by the VC ecosystem. So if you put 2 and 2 together, they know that out of the 24 deals that they're going to do, it's likely that 20 go to zero, 2 survive, 1 thrives, and 1 knocks it out of the park. Now, doing the math, they need to change, they need to transform those $10 million, those actually $240 million into 1.2 billion, but 20 deals went to zero. So you have 4 startups that need to explain and need to return every single dollar that you promised to limited partners. And the quick math here is, for a winner, you need maybe a 40x. Those $10 million you need to transform at least to 400. Otherwise, there's no way you're getting there. And you invested at what? A $50 million valuation. X, you would think is a $2 billion exit. But there's been new rounds, dilution, employee stock options, tender offers, whatever, you've been diluted. So you actually need to exit this company at a $3 or $4 billion valuation. And in order to exit, you need there to be a round or an IPO. And if there is a round or an IPO, that means the company that's gotten to that stage still has a lot of upside potential to go, maybe even at 10x. And they can get to $25 billion in valuation. And for a company to do $25 billion in valuation, they need to have a path to making at least $2 billion in revenue. So there you are. We started the exercise thinking about this company doing 2-3 million ARR, knocking it out of the park. And on the other side, the VC is thinking, can this company go to 2 billion in ARR?
Right.
And then you need to think as a founder, what evidence am I presenting across all of my materials that would even hint to the fact that this could go all the way to $2 billion in revenue? And usually the answer is nothing. And that has to do with any number is going to be exaggerated and blown out of the water because they don't have experience building companies that big, because a bunch of things. And then they're going to end up on Twitter saying VC is broken because they got a rejection and they actually have a solid product. But VC is not broken. It just knows that the majority of companies are going to zero and they can only invest in the companies with tremendous upside. So I'd rather invest my money into an extremely high-priced AI pre-seed round that has at least a tiny sliver of a potential to knock it out of the water and rewrite that category. I can do that. I can justify investing in that. Because if you give me 24 shots at goal with 24 different companies and I hit one, it is 10 or 100 times more profitable than investing in the companies that are breaking even, growing consistently, but at a steady pace, and have a strong team, but are not crazy enough. So all of this to say, your pitch is not crazy enough. And that's why I'm passing.
Yeah. I think it's so important for founders to understand just that basic VC math. Like, what are they actually like looking at the end of the day with the numbers that you show them? It is all built on assumptions. And if an investor doesn't fully understand your business model, if they're not fully getting sort of the message and see like what it's going to return, then, I mean, you can't take that rejection personally. You just have to make sure your pitch is as good as it can be and feed them the information they need. But I feel like it's also really important to find investors that will understand your business and maybe are a good fit as investors. And I'm wondering how you help them find those investors that are, a good fit. Because you can pitch to, 100 different investors, and like your numbers earlier, like maybe 2 will want to invest in your business, but how do you help founders actually find those investors?
What I've found to be a very strong value proposition that I'm developing at Oz is because I can see from the inside how a single founder interacts with 40 or 50 funds, I can then take that to the second founder and tell them, hey, this fund, the guy that makes the decisions is this person. In this other fund, she is the one that knows fintech. So we need to get to her. And she invested in this company in the past. So let's get an introduction from this founder to that fund. And if we can do that, that's again tilting the leverage in favor of a founder who was going to play the game, but maybe there's so much luck and inefficiencies involved in this process. Like there are so many attempts of let's apply that data science to venture capital. There surely is a way to do that, but the learning curve is so long. And how do I know if the reasons why we wanted to invest in Pomelo back in the day, our rationale, if that is why the company was successful or not? So it's a weird answer, but you have to take a more pragmatic approach to it. And that's why through us, seeing how the funds interact with my founders, understanding who jumps to the call quickly and why, and who sends an associate versus who goes straight with the partner. How do the US funds come prepared for calls versus the Latin American funds? How to get a 45-minute call instead of a 20-minute sync, when to do the roadshow, when to involve your VCs for follow-ups and to apply a little bit of pressure to the companies. There are a bunch of strategies that you can run that don't change the fundamentals of the business, but drastically change the conversion rate of the pipeline. And I'm not saying necessarily that they increase or because you're working with us, you get success and without you wouldn't. But sometimes it's about, instead of changing, let's say you started with 40 on your own, you would have gotten 20-second calls. If you change that number from 20 to 30, maybe that's already enough so that you start to become the talk of the town in the VC corridors. And suddenly it creates expectation and it accelerates the fact that you've done something well, that your materials are well crafted, that when the fund sends a list of 20 questions, thinking it's going to take them 4 days to answer, if those answers come back in 2 hours, the fund is going to be like, she's either amazing, she's answered these questions before from a different fund that sent very similar questions, regardless if she runs her company the way she's running this fundraising process, because at the end of the day, this is my only proxy of how this founder runs their company, then I need to put my partner in front of this. Because now I've seen the deal, I have all the ball is always back on my court very quickly. I need to make a decision. But I also want to illustrate a few best practices that as a VC, I was on the receiving end of. I remember a founder, we invested, and he came to the meeting. It was his third company. And he said, listen, guys, I don't want to pitch. Truthfully, 99% of chance that this company goes to zero. But in the 1% chance that it doesn't, we become the JP Morgan of stablecoin.
Yeah. It's actually really interesting because I heard from another VC that some of the best pitches that he heard were founders that addressed the risks up front. And they told the VCs, are like, look, there's a high likelihood this is going to fail. However, this is why it won't fail. And it's actually some of the best pitches they've heard. So it's kind of crazy that you brought that up. So talking about understanding the risks and just addressing that up front, right? That obviously has to build some sort of credibility with the VCs. And so on that point about building credibility, what are some of the signals? What are some of the things that founders can do and talk about that builds credibility with investors? You know, like team, like their product, like their understanding of the market. Like what can founders do as they're telling their story to investors?
One of the main things to me is showing them that you know the game that they are playing and that you're gonna play that game. That you're not racing this round because you are struggling for capital and that at some point you're gonna pivot into a lifestyle business or something like that, which we get pitched on very often. So that's why it's important to not speak more than 50% of the time and treat the fundraising process like it's a recruiting process and not a sales process. Because if you're selling, it's very difficult to create trust and empathy because I'm trying to get you to do something. I'm trying to convince you of something and force you to buy something. But if you're recruiting and you're like, hey, we're accepting capital. We're not raising capital. We're accepting capital because we're looking for a partner that can help us go from A to B. Of course, our destination is X, and we need to risk this. And we've seen your background that you were able to do this and that. So tell us a bit more about how you could collaborate with a startup where we're at. You are running the meeting. You, the founder, are the owner of the meeting. You set the agenda, you establish what you want to get out of that meeting, and you run that process. Because if you run that process, you're going to see very quickly how the language of the VC, how their tone, their kind of like their presence is going to adjust to try to find the ways to collaborate with you and try to explore together, which is what you should do all the time. Let's explore together whether we are a fit. And that means I'm going to show you into my kitchen and you're going to show me yours. And that is much better than not sharing the metrics because they're not beautiful, or trying to make it seem like everything is going great, that there are no risks in the future. That is a terrible way because it gets the VC defensive. Also, bear in mind that VCs, we are probably trained salesmen. And what I mean by this is like you're playing Quidditch and suddenly that yellow ball appears. We are there sitting around, listening to pitches, going to events, just entertaining the ecosystem, learning, waiting, like a lion that waits for maybe 20 hours so that when we see that opportunity, we go for the kill. And that opportunity, by that opportunity, I mean that company that has certain spark. And when we see that company, my attitude, I remember in my own, I have no ego in this, but 90% of the meetings, I would be like sitting back on my chair, talking about what does product market fit look like, asking who do you need to hire, what do your financial model looks like. But there was maybe 5% of the meetings where my attitude would be, we can help you with this, and partnering with us is going to open this and this and this door to you. And we have this whole team of lawyers and experts and e-commerce, and our LP is this person and this other person who's going to unlock doors to you. And once you go into that mode, it's like running away from a bear. You wake up their killer instinct. We're chasing you. And once we're chasing you, others are probably going to chase you. So that's when the term sheets with no diligence come into play. That's when you can name your price. That's when, to win the deal, there's no liquidation preference involved. And again, as we know, 99% of the companies are going to zero. We erroneously assign a correlation that when we get excited about that one company, we believe it's likely that that company is going to be the winner. And that's a fallacy. But we are so in the game, and think about my incentives as well, maybe as an associate. I want to get a deal done. I want to bring a deal. That deal might be my promotion, my bonus, it's going to open my conversation to have carry. So I don't necessarily am purely motivated by finding the best startups altogether. I also am playing my own game within the organization, which means I want to get a deal done. So this is something that happens to new recruits in venture capital. They want to have their first deal. So if you're pitching an associate that just joined the organization, they want to do their first deal. They want to convince their partner. They want to show that they can trust them. And truth be told, and this is why it's so important to know and understand the kitchen and what's going on the other side. That associate is probably not going to be there for the exit of that company.
It's all psychology. I feel like if I'm a VC fund, I want someone who comes from a psych major in school, not necessarily a finance major. And speaking about psychology, and understanding who you're talking to, can we talk about angels for a little bit and why maybe pitching to an angel is a little bit different than pitching to a VC fund?
Absolutely. I can answer this from first person because there was a time when I was wearing both the hats of a VC firm, representing the limited partner agreement that Latitude had as their investment thesis, and I was wearing my angel hat. And my criteria was completely different. As Latitude, I wanted to make decisions that would maximize the chance of having outlier returns in the fund. And as an angel, I just wanted to see a few people win and a few problems being tackled and people building solutions for my country, Argentina. And the common denominator of all of those things are empathy. I wanted to root for these people and I wanted to kind of like skew whatever I could add in value in their favor. So you look at my angel portfolio and it's all people that I empathize with, that I want to be a part of their story, that I want to be a part of their success. And I also want to be a part of their failure in a sense because they tried, that was good enough. So if I'm pitching an angel investor, I would kick off the conversation saying, listen, we're barely surviving. This is the journey of a lifetime. We don't know how this is going to go, but I know that you could help us with AB. If you can help us with ABC, then it would make a lot of sense for you to be maybe a part of this organization in some way. So I would welcome any way of collaboration. But if you want to tuck in a check, then we're going to make extremely good use of that money. And we're also inviting you to be part of this journey from the first minute. This means when there was nothing, you get a chance to be part of us when there was absolutely nothing. I cannot promise you any returns. Likelihood of this going to zero are incredibly high, but we're not quitters. We are persevere. We work really hard. And I think if anything, you're going to have a great time walking this journey with us. And that is much more compelling, if you ask me.
Marcial, this has been great, and you've shared a lot here, but there's really been one question that I've just been itching to ask, which is your kind of hot take, your contrarian opinion that you shared with us earlier. And that's it's that reserving capital for follow-on hurts the ownership of the first check, and you don't think that follow-ons are a good strategy in venture capital. Can you just unpack that for us a little bit and why?
I've had so many fights, not fights, but heated debates in the ecosystem about this, because it's very common for VCs to reserve 50 or 60% of their fund to follow on and double down on the winners. And that sounds amazing in practice because, again, in the example of the $300 million fund, you invest smaller checks and then you try to put in $100 million behind the winner. And if that gives you a 3 or 4x on that money, then you've returned the fund. What happens is sometimes the winners, they become very expensive very quickly. I'm not going to share the valuation at which Latitude invested in. I'm going to keep it a little more secretive, but we invested a check in a company that 3 weeks later raised a round at a 4x higher valuation. If we would have had reserved capital for follow-on, that means our first, and this is what they don't share about typically, is your first check would have been a third of what it actually was if you don't reserve capital for follow-on. And then the capital from the follow-on that you need to invest in order to keep your allocation or increase your allocation is 5 times bigger than what the initial check would have been. So the premise, if you want to have capital for follow-on, is that the information that you're going to get between the first check and the second check is so conclusive that you're confident that you're making the right decision because of the information that you gathered between the first and second check. But again, if you understand and you see empirically the performance of companies, what are you going to learn between seed and Series A that's going to provide conclusive evidence that this company is on track to the $2 billion in revenue? And my perspective is that that's almost nothing. And then it's incredibly difficult for funds in practice, operationally, to manage this follow-on capital. Because when you invest the first check, you're telling them, yes, we reserve capital for follow-on. We reserve 60% or this amount for follow-on when you're knocking it out of the park. More often than not, the company is going to come knocking on your door as a fund telling you, please invest the follow-on money on me now because I'm struggling, because I'm on the brink of something amazing, because I got a check from a tier 2 fund, something like that. And you as a VC, you've already committed to supporting this company. And in my experience, it's incredibly difficult to tell this company, no, I'm not going to invest the follow-on money because I'm reserving it until you have more conclusive evidence, because that's going to erode the relationship. That's going to hurt your reputation as a VC of how you help companies. And because it shows that your incentives as a VC are not aligned with the startup, because that first check was an experiment check. It was to see whether you were actually going to put them in your actual portfolio, which are the ones that raise the follow-on money. And for those reasons, I'm out like Shark Tank. No, but for those reasons, I'd rather, if I say that I'm a pre-seed fund, maximize the ownership that I get at pre-seed. Sure, I'll get diluted, but that dilution is going to be higher. It's going to be at a better. I'd rather buy 1% of a company at pre-seed and see that dilute to 0.6 than buy 0.5% of that company and put in fresh capital to pro rata and keep my 0.5. And in the pre-seed is where you can get, or in the earlier rounds is where you can get this skew mostly in your favor.
So follow up then, because I'm generally kind of curious, because I know with follow-on checks, a lot of it kind of stems from founders having, the initial check is obviously highest risk, right? Like the VCs had never worked with that founder before. Maybe they have, but most of the times they haven't. So they're still trying to understand how those founders operate. And I think a lot of times the follow-on check allows the VCs to kind of track those founders over time and then de-risk that follow-on investment. And so that follow-on check is a little bit more de-risked than the first one, right? But at the same time, from the founder's perspective, at least my understanding, right? And this is where I want to like learn from you because you have a lot of good experience working with founders. And I feel like from the founder's experience, it's also that if someone supported you in the first round, it helps if they support you in the following rounds because it helps fill up the round a little bit and show confidence to other VCs that a previous VC, an early stage VC that invested you in like, let's say they invested the pre-seed round. They invest in your seed round as well. That shows that's like a confidence signal, right? For a lot of investors. But a lot of times, because I've seen this happen before where an investor didn't invest in a follow-on round, like a seed round, and that shows a signal to other VCs that like maybe they don't have the confidence that these folks are doing something right. So how do you think about that?
Let's go back to the first question, which was, and please type down the second question, but the first question you said, when the VC builds out the relationship with the founder in between the rounds, that gives them the information to make a better decision. But that assumes that has a huge assumption that you've learned conclusive evidence on that team. And sure, you're going to maybe know whether they are fraudulent or not fraudulent. And I'm going to pick him as an example, but it's very likely that if you invest in Elon Musk in a seed round or a Elon Musk type character, that after you invest, you're not going to love that founder more. He's probably not going to be sending you investor updates. He's not going to be answering your messages. You're going to ask him for metrics that he's not going to fill out your spreadsheet. And maybe there's another founder that's amazing and he's a friend of your cousin or whatever, and he's very friendly. And there's going to be a lot of psychology and bias towards who deserves and who you want to win, which is very different from looking at it as a number, as a code, and backing them based on fundamentals. Because at that point in time, there aren't really those many fundamentals. Take Slack as example. We all know that Slack started as a video game company for this and that. If they come and ask you for a follow-on investment because the video game company is crumbling and they're going to pivot into enterprise communication tool, you should, by any rational means, say no. Or you would, of course, the founder is amazing and some funds were able to see through that. But rationally, you would say this founder is messed up. They're not pivoting, they're changing everything. So I really, maybe it's a me thing. Maybe I don't believe in myself, in my picking capabilities to think which companies are worth doubling down in and which are not in that short of a time frame. Do you know what I think would be a great strategy? You invest in the seed round and you follow on in the Series B, where it's much later or with a completely different strategy. And that's why funds, sometimes they have their opportunity funds to invest in these rounds. And then your second question was about the signaling risk. I've seen this happen so many times. Where a founder comes and tells me, I was able to get these 2 tier 1 funds to split and co-lead my seed round. And they put in, like, I negotiated down, they put in a small check here, a small check there. And I'm like, no, you shouldn't do that. You want the funds to put in the check that they feel comfortable investing in and to get the ownership that they are usually accustomed to getting. Because if you get a fund with a smaller ownership that they usually invest and the smaller check size that they usually write, that means when they look at their portfolio and now it's suddenly their game, their inclination is going to be to help the companies where they've put in a larger percentage of their fund. And even worse is a situation where you allow them to write in a small check, but you give them a big amount of ownership. Say a Series B fund that is investing in your seed round, and they got 25% of the round for just $2 million. They don't care about the outcome of that money. They just bought the optionality to invest later. So founders, please keep in mind, raise from the VCs that are the perfect fit for that round, because it's going to hurt you tremendously if they don't lead the next round. And who's going to want to invest in a company that was led by a tier 1 fund in the previous round? I shouldn't see that deal. If you invested in Nubank in the Series A and they're killing it, you should preempt that Series B at whatever price Nubank wants in that round. So again, going back to the signaling, that's a very, very dangerous signaling. But if you position yourself very loudly and you say, I do not do follow-ons, I don't reserve any capital, then once you invest, your incentives become the same incentives as the founder. Whereas if you reserve follow-on, then your incentives are not the same as the founders, because you want to invest that follow-on money at a fairly decent valuation. So you'd rather not get that round 5 times oversubscribed and a Series A at a $300 million valuation, because then the capital that you have to deploy for that follow-on is so big, or maybe you couldn't even get your pro rata share. And then that means the founder, when he's raising that round, he's going to feel the tension with you, the investor, who you've committed to that founder to help them through thick and thin. And you suddenly hear attention from your investors who are like, yeah, maybe you should consider a smaller round. Maybe you should consider a bridge round before the Series A so you can have more ammunition for the Series A. Let us put that money on, let's say, maybe the same valuation as the previous round. So you're a founder. You think you have people that have your back, and you have to sort of negotiate with them to maybe get their support or not. That's why, another reason why I believe if you as a fund, you position yourself as saying, we're not follow-on money. We put in the money and then we get ourselves to work. That is a better value proposition for winning deals than if you tell them we're going to reserve money. And the final thing is, you mentioned the excuse of it helps you fill the round faster. But that has a big question mark, that is that you got a lead investor in that round.
Yeah.
And that is 90% of the heavy lifting, is getting that. You cannot optimize for somebody be willing to put in a 150, 200K follow-on check for their pro rata and jeopardize the chances of going all in into finding a lead investor. Pushback, Cyrus. What do you think? What are the gaps in the reasoning? Let's flesh this out.
Yeah. We might have to schedule a follow-up for this, but no, that's like super interesting.
Yeah,
I think kind
of debating all of Marcial's hot takes.
Yeah. I think if I had to distill it down and tell me if I'm wrong, but I think kind of where you're coming from is VCs, like founders don't have like the optionality to later on go like, yeah, like I'll raise some more money later on, et cetera. Like founders are all in from the very beginning. So I think where you're coming from is that VCs also need to be all in from the very beginning. And they shouldn't say like, okay, like we'll track you for a little bit and we'll invest a little bit now and track you and then invest later. And they need to be like all in from the very beginning and have that conviction to put themselves in the same seat as the founder is kind of like where you're coming from, right?
In practical terms, in theoretical terms, it might make a lot of sense to have follow-on capital and then concentrate from a 30 company portfolio to a 10 company of follow-ons. That might make a lot of sense in theory. In practice, you want to win deals and you want to support the companies and create your reputation. And the best way to do that is to tell the world, I'm aligned with your incentives. I have the same goals you have. I'm not speculating. You never have to speculate with me. You can always call me when things are not doing great because I'm already ride or die.
You have a lot of really interesting opinions and a ton of really cool experience. I feel like you should put it in a book or something.
Come on, this is going to appear scripted. Yes. So I am writing a book. This is creating a lot of pressure for me to say this out loud because this is the first time that I'm saying this out loud. I have done 90% of the book. And as a mentor of mine would tell me, once you're 90% there, you only have the other 90% to go. That means editing, polishing, and stuff like that. But what I've done is my goal is to, as I said many times through this conversation, I want to tilt the leverage in favor of founders in this fundraising process. They're carrying on so much risk. So what I did is identified roughly 55 tips, tricks, or now the fancy word is protocol to raising capital. I structured that into different buckets in different times of the process, in different elements or functions like the psychology, the preparation, the VC kitchen, basically. And then every single one of those protocols, I developed them into a short, very schemable description. And I also added in every single one of those protocols, the reversal. When does this not apply? Because in venture capital, the whole game is that you want to appear unique. There are so many companies that make it. The only thing that they have in common is that they were unique in their own way at the time of raising capital. So if I write a protocol for raising capital and I say, follow these steps, then that would in itself be the worst recommendation that I can give founders. Again, that's why I'm not running a cohort-based course on fundraising, because you read the stories and every single one of them did it their own way. Some decided they were not going to speak with many investors and they were going to go meet them in person. Others decided a shotgun strategy of 200 pitches one after the other. Every founder is different. They need to play to their strengths. So I added the reversal to map and describe when does this not apply or who shouldn't follow certain types of, I wouldn't call it advice, but protocol is the way. And funny enough, it doesn't have a name yet. The idea of the book is not to make money. It's simply to have a more consistent way of supporting more founders by getting them the tools and pointing them out in my coaching sessions or whatever to say, read chapter 13, 17, and 27 because you are not positioning yourself well in front of investors when it comes to the first meeting.
I have a potential name for the book. Maybe you can call it La Frontera, the border between founders and VCs.
Boom.
I like it.
You're going to have to pay a pretty hefty trademark fee, but I think it'll be worth it in the end.
Yeah, this is how we monetize the podcast.
I think the book came first and the podcast.
What about the name though?
We'll figure it out in court. Yeah. Tom, I'm very, very good at pitching my side of the argument.
Yeah, I can tell.
So, I mean, talking about that, I don't know if you'll need any money from us because I think you were on Who Wants to Be a Millionaire in Argentina, right? Did you win any money from that?
I did. I can tell you the amount in pesos, and it's gonna sound very exciting. But
I hope they gave it to you in dollars.
I got to the final. I actually lost in the final step, and I walked away with a whopping $1,800. At that time, Tom, though, 20-year-old in college, the only reason why I signed up was because of two drivers. One, my mom knows every answer to Who Wants to Be a Millionaire and she doesn't want to participate. And number two is my brother is so shameful of my lack of shame that I thought, hey, I can satisfy these two goals at the same time. I signed up. I went there. I made a blunder in the first question, but then I was 20 years old. I got enough money for a back and forth trip to Europe, and I went there. So yes, I do it again.
So 1,800 is a lot of money, but the next day it was probably worth what, 900?
Yeah, what year was this?
That's a cheap shot. That's a cheap shot.
I learned the hard way though when I studied abroad in Argentina last winter, when it was probably, I think everything was about X the price it had been for the students who studied abroad the year prior before Milei took office.
Yeah.
So I empathize.
No, but that's a funny story. And I didn't mention that when I was telling about my background. One of the reasons why I decided to become an entrepreneur was I had started at Mercado Libre. I got promoted 3 times within 3 years. And my salary was 80% of my starting salary.
That's insane.
And you just look into the future and you think, this is not sustainable. Like I was loving my work, Cyrus, but you cannot think of yourself doing a career there and holding on 10 years. So when that is not in the equation, that pressure that gets applied, actually the riskiest thing at that time was thinking that by playing it safe, aka staying the course of the corporate job, you would get to any sort of success or any sort of financial independence. And in fact, the only available option was to take as much risk as possible at that time. And it sounds counterintuitive, but sometimes emerging markets, they create that friction where there isn't such thing as the golden handcuffs. So what's the difference between working full time and making, maybe this number is relative, but making $800, $900 a month versus trying luck as an entrepreneur and maybe making zero? It's a much lesser difference than if you are working at McKinsey & Company in New York, making 300, 400K to decide to quit that and to have a rent that's maybe $4,000 versus my rent that was $150.
I want to live in your building.
That's
back
so
in the day.
That's so interesting though. That's something that our professor kind of taught us when my question was like, why have in Argentina there have been some amazing founders that have been so successful? The entrepreneurial ecosystem in Argentina has been flourishing, over the past, decades. And one of the reasons he said was exactly your point is, working a steady job is not always so steady when the economy kind of like swings in a country like Argentina. So kind of owning, making your own keep and going at it on your own, like might actually make more sense.
And can I add something to that, which is most of Argentinians, and this is true in many countries of Latin America and America, we are descendants of immigrants. Like my great-great-grandfather, he was in Spain, his family was not flourishing, and maybe his opportunities were not amazing. Somewhat mediocre situation that he could see and foresee versus hopping on a boat, traveling halfway across the earth and trying to find and make his own way. Like we're all descendants of the family members that made those decisions. And I really believe that those are things that then continue through generations. And it's been demonstrated that immigrants and sons and daughters of immigrants, children of immigrants, they make some of the best entrepreneurs in their markets.
Marcial, this has been great, man. I really appreciate you coming on and sharing your thoughts. This has been really interesting.
The pleasure is mine. I enjoy this so much. My wife is tired of hearing me shout in the house and speaking about these topics. She just wants to do something else. So thank you guys for listening to me.
Of course.
That was great. It was scintillating.
Awesome. Thanks, Marcial. Thank you for tuning in to another episode of La Frontera. We hope you enjoyed the show. You can listen to more great conversations on our Spotify, as well as on your other favorite streaming platforms. You can find us online at lafronterapodcast.com, and make sure to subscribe to our newsletter for show notes and to stay in the loop for new content. Ciao for now.